Okay, class, this will be a continuation of our lecture on sources of equity capital. As you recall, part one dealt with different types of ownership structures. Those ownership structures are referred to as co-ownership because a buyer goes in with other people. Part two is going to deal with more of direct ownership and specifically direct ownership through institutional and private investors. Now, you may think that because large amounts of dollars are invested into these funds, that they would hold the majority of the real estate. But as we will soon find out, that isn't the case. Direct investment, as opposed to indirect investment, gives individual and institutional investors complete control. They make the decisions on who leases the property, who will manage it, what the LTV for debt would be, who the lender will be, and when it is sold. The investor, though, must supply the expertise in order to make these decisions. Investing directly in real estate is normally an illiquid investment. Liquidity, as we discussed in class 2 weeks ago, is how fast any asset can be converted to cash. The most liquid asset is cash. Real estate tends to be an illiquid asset because the sales process takes a fairly long time, from marketing the property, from finding a buyer to closing and actually receiving funds. So there really is no liquidity in real estate. Additionally, as the size of an investor's portfolio increases, the economics of direct ownership start to make more sense. This relates to the economy of scale that we spoke about in the previous video lecture. As the size of the portfolio gets bigger, and as a result, the size of the management fees or the income received by the owner increases, it makes it easier to retain in-house experts, such as legal, property managers, or hire consultants to help to manage the property. As the portfolio also increases, it helps an investor to diversify risk. And they do that by investing across different asset classes, such as multifamily, retail, office, etc. Some others include industrial, and also mixed use. While not an asset class, many of the properties you see in a city are of the mixed use variety, meaning that they would combine elements of other asset classes. And being able to invest across these different asset classes will create liquidity because as one asset class is thriving, another may be on a downward turn. So the diversification helps to stabilize investor returns, and it may help to create liquidity by being able to sell one type of property in a hot market as opposed to having to hold it and waiting for the market to return if you only are investing, say, in multifamily. Direct ownership isn't always or doesn't have to be related to large companies. Smaller operations also invest directly in real estate. Some investors purchase single family or two family homes. Anything up to a four family is considered residential, and many people invest in these properties and rent them out. Their investment metrics may be different than an institutional investor, but as long as they could generate some free cash flow after the loan is paid off, the smaller investors are very happy. They also tend to own and manage these properties, meaning They not only own them, they act as the property manager and they don't outsource that to a consultant. The reason being is they don't have enough cash flow to warrant that expense, or they pay themselves a salary to do that. Another area of smaller direct investment is in owner-occupied office buildings. One of the drawbacks that smaller players or smaller investors face is the lack of diversification in their portfolios. So they become very exposed to market downturns. However, they tend to possess a lot of local knowledge. So there's always a trade-off. Does having that knowledge or that local knowledge offset being only in one asset class? And this is not always or only prevalent to smaller investors, because there are funds such as Colony Capital and other firms that were created to take advantage of the single family marketplace. What Colony Capital did is they went after primarily foreclosed homes in areas that had an abundance, such as Arizona or Nevada, and they bought a whole bunch of single family homes located in close proximity to one another. This allowed them to hire one property manager to handle all those properties, since they weren't driving miles and miles to the second owned property. They were able to just handle those properties in one neighborhood. And they actually ran it then like it was a multifamily. And instead of these units being in one building, they were in one development or in one block. This also allowed them to sell off the buildings or sell off the houses individually as the market improved. And in fact, Colony is actually wrapping up one of its single family funds as we speak, and they've done very well doing so. Privately owned commercial real estate is approximately a $2.8 billion or $2.8 trillion endeavor. There is a lot of wealth and a lot of money invested in direct ownership of real estate. Through that direct ownership, or I should say, entities other than individuals hold these properties, such as REITs and private equity firms, but the large majority, roughly 88% of all privately owned real estate, is owned by non-institutional investors in both large and small properties. As we could see, only about $350 billion, or 12% of that nearly $3 trillion number, is held by these institutional investors. If you don't know, an institutional investor is just an organization that is set up to invest either on behalf of deposit holders or on their own behalf. An institution is a corporation or a fund. And as you can see, according to the ULI, the Urban Land Institute, about $2.1 trillion is invested in smaller properties throughout the country, as opposed to the larger properties. Just as in small business is the majority of the economy, or makes up a majority of the businesses established in an operation, smaller properties make up the majority of the real estate market, and as such, smaller investors help to drive the economy. And you see a lot of that in and around the city. In Manhattan, the larger transactions dominate the headlines, but the majority of buildings that are traded are sold to smaller investors. These 6-unit, these 8-unit walk-ups dominate the outer boroughs and are the predominant source of transactions, or I should say the predominant asset class that is transacted as opposed to these larger buildings. This concludes part 2. In part 3, we'll start looking at who these institutional investors are, starting with public equity investors, otherwise known as real estate investment trust or REITs.